Good morning. Happy Thursday. Is it Thursday? It's Thursday. Um, you guys hear me okay? I hope. Guys, it is Good Friday Eve. So it is the day before a holiday, which means things can go a little funky sometimes. Make sure that you are adhering to your advantages. Make sure you're following rules. Make sure you're sticking to your plan. Make sure you're not creating trades based on emotions and feelings and all that stuff. Just get in, have fun. Um, Sorry, to reply to my brother and tell him to leave me the hell alone for a minute. Um, Good morning. I'm excited to be here. Is it weird that I get excited to go to work? I love coming to work, guys. I love working with you guys. And I love talking about advantages and I love talking about rules. And I get excited watching you guys grow. And I'm just going to tell you right now, before I really get into my spiel, that I see the absolute most growth in the people that participate. I see the fastest growth in the people that really commit themselves to following a plan. And I see the most intense growth from the people that are willing to keep it simple initially. Just throwing that out there. Do with it what you will. Um, some days it's like pulling teeth to get people to participate. Other days it's outstanding. But I'm here for you guys Monday through Friday. Good morning, JW. 15 hours a week, give you feedback on everything. Everything that you do, everything that you see, everything that you think, I'm going to offer feedback. And everything's going to revolve around advantages. Can't stress that enough. So the first advantage I give myself is I go to forexfactory.com every morning, and at 8:30, I knew that there was news. Final GDP, unemployment claims. Guys, this is high impact. And I'm going to tell you that some days it's going to suck to respect the news. I was in the perfect long. And I exited 2 minutes before news. And once news broke, it went straight to my target, $500 in the distance. But there could have been an opposing force that made it go the other way. So I choose not to trade news. At 9:45, we have Chicago PMI. At 10 a.m., we have pending home sales, guys. Medium and high impact news can absolutely ruin your day, is the easiest way to put it. You never know how someone's going to react, so it's better just not to be in front of the reaction in most cases. Everything that I talk about comes from the tutorial section, guys. Everything that I talk about comes from the education page. And I'm going to tell you right now, simplicity. I can't stress it enough, guys. Simplicity. We're going to talk about a high probability trend trade today. This trade has 3 rules. Each rule provides an advantage. It's the accumulation of advantages that create a trade. It's not anything other than that. It's not, I think it should go up here. I want it to go up here. I need it to go up here. Guys, if you look at your chart and you say to yourself, I have momentum, a clear path, and an entry area, you have a high probability trend trade. You have a trade that typically wins 70 to 80% of the time. You have a trade that creates confidence through the memory of success. But the most important thing that this high probability trend trade does for you is it teaches you to become a chart reader, guys. And that's the most important skill. The absolutely positively most important skill that I think you can get if you really want to be a day trader, if you really want to be successful, if you want to make your living in the markets, is you've got to be a chart reader, because your chart reading is what gives you the advantages. The chart reading is Gino. Sorry, I missed that. What's your question? Are there fibs, divergence, one-to-ones on the recent bottom of the 34.5? There was a divergence low that it hit to the tick, turned into a pivot stop out, and that's what created the move up. So do this, Gino. If you've already tried reloading, okay. So do this just for grins. Dun, dun, dun. So this is the first thing that I do because it's the quickest and the easiest. Close all your workspaces. And then once you close your workspaces, go repair and reset your data and see if that fixes it. If it doesn't fix it, then you're not going to want to do this, but you're going to have to start fresh. Delete all of your workspaces, delete all of your templates, and rerun the indicators from the resource page and just start fresh. And that's the easiest thing to do it. And when you say you reloaded, what did you do? Did you F5? Did you right click, reload historical data? Just so I know what you did. Reloaded historical? Okay. Then what I would do is I would go ahead and repair. But let me ask first, Gino, is your chart in Eastern time frame? You're on the Eastern time zone? Okay. Let me pull up my NASDAQ large chart real quick. Yeah, this is what I'm looking like. There's a lot going on there on the 34.5. But that was the absolute perfect pivot stop out, setting up the long trade. And I think so too, Cav. I think there's a point. So one thing you can do as well, Cav, is just build a new 34.5 and build it without any templates. So go new chart, and the instrument is going to be the NASDAQ. And let's do a dynamic Renko chart, but don't put a template on it yet. Go 34.5, make sure tick data is there, and click OK. And then that's just going to bring up this ugly chart like this. Right click on it and load in your template and go to the NASDAQ Futures 34 Dynamic Renko and let it calculate through. And sometimes I'll do that if I feel like a chart is having problems. Sometimes I'll do that if my brother and I don't match up. And that's just one of those things that I'll do every now and then, because it's a digital world, and digital worlds have problems. And it's still loading right now, but I think it's easier than just building a chart, though, is you can go through and actually load the workspace in brand new. Building just a chart is good, but when you put in a brand new, fresh workspace, everything is solid, everything is fresh. So you can do that. And then, of course, you know, the go-to, guys, is if the simple fixes don't work, go to Jason and let Jason help you. Jason's amazing, and Jason will always help you. So don't be afraid to go to the tech. And then, guys, everything that we talk about each and every day is chart reading. Every day it's chart reading. Every day it's just taking these amazing indicators and understanding what they're telling you. And creating, I won't even say expectations, but giving yourself the opportunity to recognize patterns that repeat themselves over and over. And chart reading is what's doing that for you. Is you're beginning to recognize patterns, and that's really all it is. This pattern says the market's likely to go up, and this pattern says that the market is likely to go down, and this pattern gives me the highest probability entry to continue with the trend. And that's what we're going to talk about, guys, is chart reading. And 90% of your day is reading your charts. 90% of your day is waiting for the advantages to come into place so that you can utilize that trade entry precision that the high probability trend trade gives you. Because when you're a chart reader, you're going to understand some very key concepts. You're going to understand where the market is likely to continue. And that's actually what becomes your entry on that highest probability trend trade. You're going to understand where the market is likely to go, and this is going to help you set up targets. And then ultimately, you're going to understand where the market is likely to stop. And likely to stop is what we call a termination condition. And I think that you guys will find that termination conditions and the ability to recognize them pays huge dividends. Termination conditions can stop a market in its tracks. Termination conditions can reverse a market. And when a termination condition does reverse a market, it sets you up for success with strong trigger lines in the other direction. So we're going to focus heavily on chart reading, guys, and we're going to give it everything that we have just to be consistent with the chart reads. And to make sure that you're doing it correctly, your fastest way to becoming confident is to post your chart reads in the room. Not post your charts in the room, but post your trades, post your reads. Identify what it is that you're looking at. Tell me what you were feeling, what you were thinking, what you were seeing, what compelled you to get into the market where you got in. And I want you to do it with this in mind. And we're going to look at a couple pictures here. The first thing is every time you take a trade, whether it's a high probability trend trade, a momentum trade, whatever, I want you to identify advantages. I want you to get to the point to where you're embracing the chart read. You're embracing the advantages present more so than the desire to win, because winning is typically a result of the process rather than the desire. So when you post in the room, the goal, of course, is to make sure that you're reading your charts correctly, to make sure that you're understanding these very basic concepts, whether it's momentum or terminations, whether it's a good bottom or a good top, and understanding your entries. So if you can tell me what kind of trade it is, first and foremost, then you're going to understand whether or not you have rules for it. And if you're not sure what kind of trade it is, it's going to be difficult for you to follow the rules. I want you to use two charts, large chart, small chart. I want you to identify the momentum on your charts, whether it's a trend trade, a momentum trade, an HVA trade. I want you to tell me what the momentum is, because I want you to begin to recognize and speak to yourself in terms of momentum. I also want you to identify the areas. Even if you're trading into it, I want you to put on your chart, I made the choice to trade into a potential termination condition, and then tell me where you entered and tell me where you exit. And guys, the reality is that we go through this wonderful back and forth every time you post a chart, and all we do is we focus on chart reads. We make you a better chart reader, because when you are at the top of your game on chart reading, becoming a trader is much easier. The second thing you can do, the second work you can put in for your own personal success, is use that spreadsheet that Nexgen gave you. And I'll drop mine in the room right now. I share it every day, so there's really no excuses not to have it. The first tab is a trade journal. It's your trade tracking. Every time you take a trade, put it in here. What did you see? How did you feel? And then the big one is, what was the feedback in class? I took this trade, I won this trade, but Mark said I got lucky trading without momentum and into areas and from the middle of nowhere. Maybe this isn't a trade that sets me up for long-term success. I might want to avoid it. There's the favorite look section. As you guys begin trading the rules, understanding the rules, embracing the advantages, you're going to see the same look over and over. You're going to see the same advantages over and over. Guys, this is the basis for a trading plan, is a set of rules, first and foremost, that provides a statistical advantage. A set of rules that has been proven to win more than it loses. Because if it doesn't, why on earth would it make it into your plan? A set of rules that is repeatable. It has to be the same pattern over and over. You should be able to show me 10, 15, 20, 30 pictures of the exact same trade, because consistency is the key. And every time you see a trade, take a picture of a trade, enter a trade that fits your rules, that gives you that advantage, drop it in your personal trade setups. You're building a trading plan. And then I've got about 300 pictures of client trades. I've got entry sequences, management sequences, patterns that repeat itself, termination conditions. This is me putting in the work for you. And that's only going to take you so far, guys. If you watch videos of Tiger Woods all day long, you're not going to go out to the course and shoot a 65. But if you put the work in, if you learn it, if you understand the mechanics, the odds are so much better. And then finally, for my brand new users, or for you self-proclaimed more experienced users that continually make the mistake of calling weak triggers strong triggers, or calling a clear path a termination, and vice versa. Guys, this is designed to commit looks to memory. I created this tab. It's the 101 tab, and it's the basic advantage. Strong triggers, clear path, and an entry. And the green sections represent the advantages that we look for in the high probability trend trade. The red section represents the opposite of having the advantage. If it's not strong triggers, well, then it must be weak triggers. If it's not a clear path, maybe there's a termination. And then the yellow is the, hey, let's pause. Our rules are kind of met, but not really. if you commit 10 pictures a day, right, of strong triggers, in a week's time, you'll have 50 pictures of the exact same look committed to memory. If you take 10 pictures a day of weak triggers of a clear path of termination conditions, guys, in 1 week's time, by the end of the week, you will have invested a few hours in your education, but what you'll have is the most solid study guide that you could ever create. I'll probably steal it from you if you actually do the work. But what it does is it creates recognition through repetition, guys. And advantages are nothing more than looks on a chart. They're patterns on a chart, and you've got to be able to recognize them at a moment's notice. So we're going to learn the trigger lines. We're going to understand the rules for when it's okay to trade. I encourage new users, although I don't tell you to because I don't tell you what to do. I encourage new users to keep it very simple in the beginning, to focus on this high probability trend trade and let your efforts go towards becoming a chart reader rather than a simulator millionaire. I do want you to simulate, right? I want you to practice. You've got to get out to the batting cages and swing that bat, or you're never going to be ready when it's time to go live in the game. But the goal is that you're practicing the correct rules, right? If you're going to bat from the right side of the plate, guys, don't play on the simulator from the left side. Don't go to the batting cages and try to be a left-handed ball player when you're going to perform as a righty. Don't practice the wrong trades. Create the muscle memory that's going to give you success when it's time to go live. And we're going to simplify excessively in the beginning, guys. We're going to talk about that high probability trend trade. That's going to be the focus. What looks are you going to commit to? What's it going to take to get you into that market? My hope for you is that it's going to be advantages, that it's going to be nothing more than the accumulation of advantages that make you pull the trigger. And then if you focus on the entries for this high probability trend trade, if you promise me 20 days of being focused, I can almost guarantee you that by the end of 20 days, focusing on the most simple approach, you're going to be absolutely astounded at how well you can read your indicators, and you will be absolutely floored by the opportunities that you begin to recognize in the market. But it comes from that place of simplicity. So the high probability trend trade, 3 rules, guys, that's it. And the rules provide advantages, and the advantages are how I want you to speak to yourself every time you look at the market. Your large chart must have strong trigger lines. That provides you the advantage of momentum. Your large chart must not reach any of those likely to stop areas, those termination conditions, and that's going to provide you the advantage of a clear path. And guys, if you're doing 120 on the highway and there's nothing in your way, it's hard to stop you. It's hard to slow you down, and you're not making a U-turn without a little bit of thought first. And when these 2 advantages are present, you will be able to pinpoint very precisely where the market is most likely to continue, and you'll be able to use that for your entry. So these 3 rules, these 3 advantages are going to come to be on one chart. And more importantly, your first 2 rules are going to come from the most current bar on a large chart, because a large chart is a broad stroke of a brush, guys. A large chart is a slow-moving chart. This large chart will define the direction of the market. It'll define the momentum of the market. It'll define the areas that may be problematic on the market, or even more so, it'll help define the areas that just reverse the market, that are creating this advantage going the other direction. This broad stroke of a brush is the overall opinion of the market, guys. This is what the large crowd wants. This is what the people with money want. And more importantly, that's what this guy wants. That's Norbert. Norbert's our little mascot here. He represents the deep pockets in the market. Norbert is the guy that swims around and very few people can hurt him. Norbert swims around and he creates the direction of the market. And he establishes momentum in the market. And this is the guy that reacts to areas. So what we can do, or what you can do, is you can be a remora. Is you can wait for this guy to create your momentum, to establish your clear path, and then to provide you the entry area. Or you can try to be first. You can be a small fish in a big pond and still try to run the roost, and it just doesn't work out like that. So following the large crowd is such an advantage, guys. There's just no reason to fight them. What's cool, though, is there's always somebody who will. These are the people that get on the wrong side of direction. These are the people that fight momentum, and these are the people that are going to push us right back to our best of the best entry. And they're going to do that on a small chart when the large chart has established momentum and a clear path. And this small chart is 15 to 30 bars. And it refines that broad stroke of a brush. It gives you an x-ray of the most current bar. And what happens is when everything on the large chart is strong and up, you're going to buy Fibonacci support on a smaller, faster chart. And when everything is strong and going down, you're going to sell Fibonacci resistance on a smaller, faster chart. And this refinement process allows you to reduce your risk dramatically. It allows you to increase your profit potential exponentially. So trading with the trend and trading with the large crowd is really the best advantage you can give yourself right out of the gates, guys. This is going to eliminate a lot of mistakes and an awful lot of opinions. If the background on the large chart is green, it's going up, why not go up with it, right? And if the background on the large chart is red, it's going down. Why not go down with it? There's no reason to fight. The shark's going to get you. And the cool thing is the only way you can have the advantage of momentum, the only way that you can have those strong trigger lines, rule number one, is if the background of the color matches the small triggers and the large triggers on the large chart. Small triggers are the solid lines. They're a faster moving average. Large triggers are dashed. They are a slower moving average, but these two work together, guys. It's a symbiotic relationship. When the small triggers break above the large triggers, when there is space created between the two, I want you to see how it looks like scissors are opening right where my little laser pointer is. This is strong triggers. Strong triggers mean that the odds are favorable for the market to continue up. And the cool thing is the strong triggers have the potential and the ability to break key Fibonacci areas. They also can cover some of the mistakes that new users make, whether it's trading into areas or fighting divergences or something like that. So in an uptrend with strength, we're going to buy Fibonacci support on a smaller, faster chart. It looks like a tail on that one bar. That's all it looks like this wick or this tail, whatever you want to call it. Remember that there's a dissection on the smaller, faster chart. You guys are going to be able to pinpoint right where the bottom of this tail is most likely to form. This becomes your entry for the highest probability trend trade. So you can scroll back historically on your large charts and see these tails when the rules are met and give them a circle. And I'm going to show you how to study the rules for this trade to begin to develop trust. When the background is red, the market's going down. I'm only looking for rules to be met for high probability trend trade short. I notice that my small triggers are below the large triggers. All the colors match and there's space in between the two. It looks like scissors that have just opened. I know that this is strong triggers. This is my look. This is always the look of strength. And when I have strong triggers down, selling Fibonacci resistance on a smaller, faster chart is my best bet. So strength in the move, guys, it's going to break areas. Strength in the move, it's likely to push the market down. Strength in the move is when we're going to have the highest advantage to go with that direction. And just like anything, momentum is cyclical, right? It's not 100% all the time. Otherwise, we'd never have opportunities in the market. The market is a big fight of fear and greed, fluctuations. So when I have odds favorable momentum, when I have strong triggers, that's my best of the best, guys. This is the focus for the brand new user for at least 20 days. Learn to give yourself those really, really fast markets that provide an advantage. You guys will be able to sell Fibonacci resistance, pinpoint it on a smaller, faster chart. But when both triggers are down, when one of the small triggers is inside of the large triggers, this is a first sign that momentum is slowing. Doesn't mean momentum is gone, but it is slowing. And short trades can be taken if the other charts agree. So you're going to rely on your chart reading to understand whether or not the other charts agree. And then when both triggers down, once both of the lines of the small triggers work their way inside of the large triggers, you have a weakening or a slowing of the trend. You're going to hear me say it in class a lot. You have anything can happen triggers. And it really takes away the confidence of getting into a trade. But there still may be trades available, especially as you grow with the software, as you begin to recognize more and more advantages. There will be opportunities in each stage of this trigger look, but this is your best of the best, guys. And if you just love language the way I do, this is odds favorable momentum, guys. This breeds confidence. This is anything can happen. And if I just said to you, hey, I want you to bet $100 on one of these looks, which ones do you suppose it's worth risking, right? Which one gives you confidence in the prospects of you winning? It's got to be odds favorable. And that's exactly what trading is, guys. It's taking these advantages and then turning them into trades and being comfortable with ignoring the disadvantages because they don't give you the best chance of success. And these anything can happen triggers, when they hit areas, man, that's where markets look to reverse. That's where areas end up holding. That's where decisions are made by the people in control. And that takes us to rule number 2. Good morning, Roku. Termination conditions must be false, guys. Termination conditions mean that the market hasn't reached an area that's likely to stop it. And if the termination conditions are false, the cool thing is that you're going to have room to your profit targets. And if you have room to your profit targets, guess what? You have the advantage of a clear path. And once again, we're going to use lines on the large chart to define the areas that the people in charge may be reacting to. These areas on a large chart, guys, these are going to be the areas where buyers buy and sellers sell. These are the areas where profits are taken, where fights are had. And what you will find is that with a simple process, you're going to understand whether or not these areas are likely to stop the market. You're going to understand whether or not they have the potential to break, or whether or not these areas have broken. I'm going to give you this picture in the room because that's the visual of the areas in question. And these areas may reverse the market. And I think that that's such a powerful word, is that the areas, may reverse the market. They're not guaranteed to reverse the market, but if they may, then it pulls away your statistical advantage. And I want you to think like that. I don't know if this area is going to turn the market around, but I know that it may, and if it may, well, then I don't want to trade into it. And these areas are blue Fibonacci support and red Fibonacci resistance and yellow 1-to-1 dots. Magenta and divergence high lines, low lines, guys. The most ignored and forgotten termination conditions on a large chart. A cyan divergence low line, a magenta divergence high line. And let me just show you, just from the day, how powerful those lines can be. And we're going to get into more about why they're powerful, and we'll get into more about what it means to have them. But I want you to see, just let me blow this up. This is a termination condition. This is a termination condition by Nexgen standards. This is a divergence low line that was present for an hour and a half. For an hour and a half, we knew that it was there. For an hour and a half, we knew that it may reverse the market. And for an hour and a half, it had absolutely no bearing on anything until price got back to it. And look how the market reversed from it, almost instantaneously. You guys have the advantage of seeing these long before you get to them. You guys have the advantage of a simple recipe to understand whether or not it's likely to hold or whether or not it's likely to break. And it all starts with price reaching the area. Price has to reach an area for the decision-making process to be set off. Price bars must get to the area, whether it's support, whether it's resistance, whether it's yellow 1-to-1s, and even those divergence high and low lines. But when price reaches an area, in this case Fibonacci support, check your trigger lines. The same triggers that give you momentum or that let you know that there's not momentum, guys, if they're not below support, don't take any trades into support. This is an area that may reverse the market. And I can't be any more simple on this idea. If price reaches the divergence low and the triggers remain above, don't go short into it. If price reaches Fibonacci resistance and the triggers remain below, don't go long into it. And guys, if you were watching the NASDAQ yesterday, and let's see if we can find that area where the market literally consolidated between support and resistance and support and resistance, support, resistance. And guys, I'm telling you right now, once you begin to recognize this look and once you talk to yourself in regards to advantages, it's going to keep you out of a lot of losers. And a lot of times, not taking the wrong trades is almost as advantageous as taking the correct trades. So if price reaches an area and the triggers don't break, no trades. So when is the area clear? Because these areas don't always hold, sometimes they break. When the small triggers, both lines, and the large triggers, both lines, get to the other side of the area, that's when the area is broken. So for the brand new user, it's simple. Price reaches an area, no triggers, no trade. You've reached a termination condition. It may reverse the market. But here's what else can happen. It may create an untradeable bounce. It may set off a fight that you don't want to be a part of. But the reality is the second price reaches an area and the triggers don't break it, you've reached a termination condition. Just write shorts off. No more. I'm not going to do it. I'm going to let the area break. Price reaches support. The triggers remain above. There's no reason to go short. And then, guys, one of the most misunderstood terms, when you see one of these divergence lines, they come off of a pivot. That's all this is a pivot. The divergence line says, hey, Mark, guess what? There was a loss of momentum right here, but that loss of momentum means jack squat to you in regards to termination conditions until price reaches the line. And if price reaches a divergence low and then trades back above it, below and back above, we call this a pivot stop out. And a pivot stop out is powerful. And it becomes even more powerful when it coincides with Fibonacci resistance. So there's a picture of termination conditions at lows. Start burning them into your brain. Commit to these looks. Give yourself this advantage. Whoops. And then where's my terminations at a high? I lost it. There it is. So once again, there's a pivot with a loss of momentum, not a termination condition, not a pivot stop out. Nothing more than a loss of momentum in the middle of space. But when price reaches that divergence high and the triggers remain below, now it's a termination condition. Price trades above and back below. Now it becomes a pivot stop out. And a pivot stop out is a very powerful indication that the market may reverse, more so when it coincides with Fibonacci resistance or support. Price reaches resistance. The triggers remain below, even with odds favorable momentum. No more long trades. Price reaches yellow 1-to-1s and resistance, and none of the triggers break through. No more long trades. And guys, look how it pulls back to support and absolutely no triggers break through. No short trades either. Because 90% of your day is spent waiting for advantages. If price reaches resistance, don't go long if the triggers are below. And if resistance pushes it all the way back to support, don't go short if all the triggers are above. It really can be that simple. Then price comes back and it reaches resistance and the triggers are below. Well, damn it, I can't go long. And now it's reached that magenta divergence high line. So that's a termination condition as well. Reaches the second form of resistance, trades above that divergence high line, and another termination because look at your triggers. And then when price is back below the magenta line, now it's a pivot stop out. And a pivot stop out of a divergence high is a very powerful indication that the market may reverse. When it's true at Fibonacci resistance or a pivot stop out low is true at Fibonacci support, it adds power to the top or bottom. So price must reach, and then we check triggers. And if price breaks through an area, but the triggers don't, it's still a termination. And guys, this happens all day, every day. Strong triggers can break areas. Strong triggers can break areas. It happens all the time. But if price reaches the area and the triggers are still above it, you have to sit on your hands and do nothing if you want the advantage of a clear path. From this termination condition here, guys, I want you to see the 45-minute fight. Straight back to resistance. None of the triggers break. You can't go long. You're into a termination directly from a termination. The colors on the trigger lines don't agree, so I know that I don't have momentum. And guys, this rattles around like Pac-Man for about 45 minutes. Until finally, we get above resistance, both triggers, resistance behaves as support. My smalls are, in fact, outside of the large. I do have momentum, and this is where you guys just pinpointed exactly where the market is most likely to continue. This becomes your entry for the highest probability trend trade. When a no triggers through termination condition reverses the market and gives you your rules, that's a strong bottom, guys. That's the one that typically wins 70 to 80% of the time. When a termination condition reverses the market, rules met, that's your 70 to 80% winner, coming off of that strong top. So I'm going to ask real quick, is everybody cool in the room? I put in the lows. Let me put in the picture at highs as well for you. If price reaches an area and the triggers don't break, is everybody okay with sitting on their hands for a second and saying, let's see what the reaction from the people in charge is. Let's see if they reverse it. Let's see if they just end up in a fight. Let's take just a second and see if price reaching Fibonacci support with weak triggers and absolutely none of them break through, is that enough to create an untradeable bounce? And guys, it turns out that it is. You're witnessing it right there. So start taking pictures. But there's one more termination condition. So if your large chart defines direction, that's pretty easy. And if the large chart defines momentum, you only have to look one space to be concerned about it. And if the large chart lines have the potential to stop or reverse the market, well, then lines on a large chart can be detrimental. But there's one more termination condition. And guys, this one happens on every chart. It happens on every time frame. I don't care if it's a minute, a daily, a tick, a range. It doesn't matter. But 3 divergences in the same price range may terminate the trend. Because your entry chart is a smaller, faster chart, because there's 15 to 30 bars for every 1 bar on the large chart, you're going to see divergence on the small chart first. This is the only condition on a small chart that will keep me from taking a trade because rule number 2 isn't met. 3 divergences, 3 losses of momentum in the same price range may terminate the trend. Becomes more powerful when you go from odds favorable momentum to anything can happen triggers. Becomes more powerful still when your third pivot's higher than the previous from a low, or it's lower than the previous from a high. Sorry, trying to get stuff out of the way. You're going to see this look on a small chart, this look on a small chart, maybe when your large chart seems to be turning from nowhere. Maybe when your large chart, even with odds favorable momentum, ends up dropping. So this small chart termination condition is going to give you the opportunity to not go short that next time. The small chart termination condition is even going to help you manage out of trades. If you're in the perfect short, if you sold Fibonacci resistance in 3 divergences print, this is a beautiful red flag telling you, hey, let's get out of that trade. Things might be changing. And that's the only termination that's going to let me say I don't have a clear path from the small chart. If the small chart triggers turn against you, momentum is defined on the large chart, right? If there's a line on your small chart or one-to-ones, areas are defined on the large chart. And one of the biggest advantages you can give yourself is to remember that the large chart leads the way. On this 1 bar on the large chart, I've defined the direction of the market. Can everybody see clearly that the market is going up because of the green background? I've also defined momentum. My smalls are above the large are wide, they're angled in the direction of the trend. I have rule number 1 met. And then price has not reached Fibonacci resistance. All my triggers have cleared the previous area. I also have a clear path through rule number 2. So now what I need to do is I need to go to my smaller, faster chart. I need to go to my entry chart. And I'm going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. I am going to use a limit order to buy or sell a pullback, this little shove that the small crowd creates. And I'm going to do it at an area, fibs, midbands, yellow one-to-ones. And here's the key, guys. If you really want it to be easy, if you really want to reduce your risk, if you want to give yourself the best chance of success, let those areas be inside of favorable large triggers. Favorable large triggers means that the large triggers on your small chart and the synthetic triggers on your small chart, which are just the large triggers from the large chart. It means that they're tight, one on top of the other. It means that they're overlapping like 2 snakes riding piggyback. And the further apart your large and synthetic are, the larger your zone for continuation becomes, the more opportunity there are for areas to be scattered on the chart. So when they're tight, you get the easiest approach to entries. When they're tight, you get the least amount of risk. And when they're tight, you have the most stress-free entries. And rule number 3 is going to make it so you can use that refinement chart to pinpoint where the market is likely to continue. So if everything is going up and the momentum is there and the path is clear, you guys are going to be able to buy low at support, Fibonacci support inside of favorable large triggers. If everything is going down, the momentum is down, the direction is down, you guys are going to be able to sell high at Fibonacci resistance by using that refinement process, by creating a dissection of this one bar, turning it into 15 to 30 bars on the smaller, faster chart. The bottom of your most current bar should be the beginning of your pullback, that little shove counter to everything that the large chart says. That tail or wick, in a perfect world, in a rules met trade, is an area of resistance inside of favorable large triggers. By selling high, we increase the room to our targets. By selling high, we reduce our risk. And we've got to be able to piece it together. So what I'm going to do is I'm going to go to the spreadsheet, the same one that I gave you guys. And I'm going to go to the client trades, and we're going to go through an entry on the short. And we're going to go through the process of discovering where the market is most likely to continue. And everything begins with odds favorable momentum and a clear path. And I can't stress that enough, guys. If you let your small chart lead the way, you're going to get run over a lot. Large chart has to be odds favorable momentum. Large chart needs to have a clear path. But when it is, you're going to wait for a reversal bar in the smaller, faster chart. You're going to wait for the small crowd to do their thing. And at the time of the reversal bar, the first thing that you should do is find your triggers. Where are my large triggers? Where are my synthetic triggers? Because I know the rules say that my areas have to be within. I'm not going short on the reversal bar. I'm not going short when it impacts the triggers. I'm only determining where my areas have to be. So once I identify my triggers, I'm going to look for Fibonacci resistance. I'm going to look for magenta midband. I'm going to look for yellow 1-to-1s. But the key is that they have to be inside of favorable large triggers. And if you get in the habit of using the caps lock every time you annotate your chart, it's going to remind you that the trigger lines are a continuation point. The trigger lines are where we expect price to correct. These are just moving averages. So the further apart the triggers are, the bigger the correction zone is. And we can limit that space by identifying the areas within and create a window of opportunity. That window of opportunity extends from the lowest point of support, or resistance in this case, excuse me, to the highest point of resistance inside of favorable large triggers. You guys are going to become so confident in this look that you'll activate a limit order a couple ticks below that area. And you'll let the small crowd do their thing, and they're either going to get you or they're not. And that's the part that you can't control. What you can control is whether or not your large chart has the rules met. You can control waiting for the reversal bar. You can control not jumping in, but rather identifying your triggers and the areas within, and you're 100% in control of activating a limit order. It's that little jaunt back that you have absolutely no idea if it's going to work or not. But if it does, you're in a short trade. You're in a short trade with odds favorable momentum. You're in a short trade with absolutely no termination conditions in the way, and you're in a short trade having entered where the market is most likely to continue. And guys, this really is the best of the best. This is the trade that typically wins 70 to 80% of the time. This is the trade where a little bit of patience, a little bit of study, and an awful lot of feedback is going to get you to where you can enter the market where it's most likely to continue. Reversal bar prints. Red box is me identifying my triggers. Blue box is me identifying the areas within. That's my window. So my limit order goes right at the top. Go in the other direction. Reversal bar prints. I don't jump in. Price reaches the trigger lines. I don't jump in. I don't enter until a tick or two below resistance, the lowest point of resistance inside of favorable large triggers. Guys, this entry is your first 20 days with me. Odds favorable, everything up. It is so close to that trouble. But remember, we're buying a pullback to support inside of favorable large triggers. That $50 to trouble turns into $250 to trouble. But if we jump in up here, we've shortened the distance. If we've jumped in up here, we've increased our risk dramatically. So guys, you can go back and circle tails on the large chart when the rules are met. If they line up with areas inside of favorable large triggers on the small chart, you're beginning to develop trust. You're beginning to say to yourself, okay, this is what it looks like when momentum is present. And this is what it looks like when the path is clear. And this is what it looks like when the rules are met for an entry. Let me drill this into my brain so I never miss it in the live market. We don't trade tails. We trade pullbacks to areas inside of favorable large triggers. We don't trade the tails. The tails are a study tool to go back historically to see if the rules were met. And guys, once you know where the market is likely to continue, you know where the market shouldn't go. And I share this every day, and I'm just going to keep saying it. A sign that you're maturing as a trader, that you're really taking strides in the right direction, is that you manage your risk before you ever manage your profit potential. And managing risk happens with the advantage of momentum. And managing risk happens by not trading into areas that may reverse the market. And managing your risk is supplemented through entering where the market is most likely to continue. Guys, these are the three most basic skills that chart reading is going to give you. And it's all allowing you to manage your risk, because when you understand where the market shouldn't go, or should go, excuse me, where the market should continue, you understand where the market shouldn't go. And that's where your initial stop is placed. 4 to 5 ticks outside of the window of opportunity. 4 to 5 ticks beyond the continuation point, beyond that point where you're expecting a bounce. And I'm going to tell you right now, and I tell you every day, guys, you will take losses. That stop will be hit. Every now and then the small crowd has just enough giddy up to take you out of a trade. And I don't want you to worry about that. I don't want you to lose sleep over the idea that you just took a loser. I don't want you to beat yourself up. What I want you to do is go back and check, did I have momentum? Did I have a clear path? Did I have an entry area? Because if I did, then I had a trade that typically wins 70 to 80% of the time. And what that means is that 20 to 30% of the time, we're going to let the market be wrong, and we're going to let it be wrong with dignity. We're going to take our small loss, we're going to dust off, and we're going to wait for the next trade. If you don't know your rules, if you don't know whether or not you had momentum, a clear path, or an entry area, well, then you're going to start questioning everything. Was it this one divergence that killed the trade? Was it this small chart, small triggers against me that killed the trade? And the answer is no. The trade just died because we're not in control, because somebody else wanted it to go up more than the pattern wanted it to go down. So I want you to be okay with that. Small losses are a normal part of a positive equity curve. If you take 100 high probability trend trades, you're going to lose 20 to 30 of them. The cool thing is, though, is if the market does everything we expect it to do and gives you a reversal bar, I'm going to reduce my risk 2 ticks above the reversal bar if it's a short, 2 ticks below the reversal bar if it's a long. And what you're going to find, guys, is through managing your risk methodically, pragmatically, through not letting emotion get the better of you, you might take $30, $40 in losses on a trend trade that fails, instead of losing $200 to $300, hoping that even though it's beyond the window of opportunity, that even though you no longer have advantages, that little devil on your shoulder is going to say, I sure hope it goes up anyway. But you're going to be able to avoid that loss, guys. Let the hopers and the dreamers do their thing. You don't need to hope. You've got a plan that has been proven to win more than it loses. You have a methodology that you can study. You have an entry that puts you in at the absolute best spot. And you have this advantage where you can literally go back and study it. And I want you to see, let's find a termination. I'm looking for a clear path here. Here we go. Termination creates the reversal. Reversal gives me odds favorable momentum. Is everybody with me so far? This is historical, guys. This is at 8:32 a.m. If I go back and I say to myself, check it out. I have momentum. That price bar hasn't hit Fibonacci support. It's close, but it hasn't made it. Let me circle the tail. And I'm going to scroll back on my smaller, faster chart. And I'm going to look for that circle. Whoop, there it is. And guys, correct me if I'm wrong. That tail lines up with a midband right there inside of the triggers. The triggers are a little split, and it goes to the top correction point, but the lowest point of resistance inside of favorable large triggers is my entry. My initial stop is up here, but once I get the reversal bar, my stop is reduced. Guys, this is how you can begin to develop trust in a methodology that repeats itself every day. This is how you can begin to become comfortable with the idea that momentum pushes a market, that momentum in a clear path is even better, and that momentum in a clear path and a pullback to support inside of favorable large triggers, well, I'll be darned, that's the most beautiful thing in the world. And guys, I'm going to tell you right now, I was in this trade, and you know what? News hit, and I exited. And I've hit close on this trade 1 minute before it ran to my target, because the patterns repeat itself, guys. And that was the only reason that I would have ever exited that trade, with the exception of 3 divergences. So price reaches resistance, none of the triggers break. Look at that untradeable bounce. And now price has reached a divergence high, the triggers are below, it's a termination. Now price is trading back below it, it's a pivot stop out. My rules say no more long trades here. I have to let things break. So guys, that's your high probability trend trade. Go through this spreadsheet, look at all the pictures. Look at the advantage of momentum for wins 300 times. You're going to begin to believe it. Go take a picture of strong triggers 25 times. You're going to begin to believe that that market cruises when it has triggers that are strong. You're also going to notice weak triggers precede a lot of reversals in the market, a lot of deeper retracements. When you have a clear path and strong triggers, you're going to notice the market tends to continue. But when you hit a termination condition, well, a lot of the times you may witness an untradeable bounce, something that would have taken you out of that long trade. And it's just no reason to give money away like that. So that is your introduction to the high probability trend trade. Guys, are there any questions about the very basic concept, finding your entries? Are there any questions about a strong top or bottom? And my brother and I are going through the definition of this together a lot, but I want to share you the 101 class, the brand new user, the most solid and the only thing that creates a strong top or bottom is when a no triggers through termination condition. This is just a termination condition. It does not become a strong top until your large triggers go from green to red. And then it's a strong top. Then it's a termination that created a full reversal. Guys, this strong top isn't magical. It increases the likelihood of these potential to break areas to break. But once you hit a termination condition and the triggers stay above, guys, this strong top doesn't give you carte blanche to trade into these areas expecting them to break. In the same way, this termination becomes a strong bottom. It doesn't mean that these one-to-ones can't hold when the triggers remain below them. Eventually, this termination becomes a strong top when the triggers reverse, things break, and then there's opportunities down here. Strong tops and bottoms are the precursor for the highest probability trend trade that you can take. If you don't have a strong top or bottom on a high probability trend trade, you may need to look for those divergences to help you out a little bit. If you have strong triggers, if you have no terminations, if there's an area for entry inside of favorable large triggers, you've defined your entry for the high probability trend trade. You've given yourself a trade that nobody in the history of this checklist has ever done worse than 70% when they mark yes truthfully. Not in my experience. But this plan is just a stepping stone, ladies and gentlemen. This plan is designed to turn you into a chart reader. This plan is not the end of the journey for you. And a lot of people get frustrated. Mark, I'm not busy enough. I'm not taking enough trades. I'm not seeing enough opportunities. Guys, if you're not seeing opportunity in the market, you're not a chart reader, plain and simple. If you're not finding opportunities in the market, you don't have a solid plan that tells you when those advantages are present and it's time to pull the trigger. And that's okay. You shouldn't as a brand new user. As a brand new user, keep it simple, keep it focused, learn to read your charts. Guys, we're in this for a marathon. It's not a sprint. This is a stepping stone to optimize your chances of success with a high probability trend trade. This is a stepping stone, and this plan is designed to optimize your chances of success with what we call a 50-50 trade. And you know what? I didn't cover that in termination, so I'm gonna give you a little insight on what that is right now. A 50-50 trade, guys, this is your first medium probability trade. A 50-50 trade means that it's not a termination condition, but it's also not a clear path. When your small triggers smash through the area in question, but the large triggers are dragging behind a little bit, they're a slower moving average. That odds favorable momentum gives this area the potential to break. And that word potential becomes paramount in whether or not you're going to find success with these trades. Because if you believe that the potential to break gives you a clear path, you're mistaken. The path isn't clear, which means that this plan is designed to keep you focused on both momentum and an entry area. So I'll give you this one as well. For the new user, it's either broken or it's not. As you become a chart reader, the 50-50 trade becomes a part of it. But guys, through simulation, through going through, pulling the trigger, making mistakes, and posting in the room, study. You've got to go back. You've got to take these pictures. You have to fill up your spreadsheet. Guys, you're not going to be a millionaire being lazy. There's very few lazy millionaires. And class feedback. That's really the key, guys, is you have somebody dedicated to your success 15 hours a week, and everything that you post in the room we'll have a conversation about. The only thing you have to do is post in the room. And I know that there's a lot of you listening right now that are getting your ass kicked in the market, but you refuse to post in the room and ask for help. Well, I'm not on a demo anymore. I don't want to take his time. Well, I own the software. I'm not leasing it. I don't want to take up class time. Guys, take up class time. I don't care what kind of trades you're taking. I don't care what your plan is. The only thing that I want you to do is tell me why you did what you did on your chart, and I promise you we'll work together to make it better if it's not where it needs to be. You're going to make your own plan eventually, and it's going to be based on your ability to read the indicators. And that's the key right there, guys. It's got to be your plan. It has to be your entry. So often I see people going, man, I'm going to take that John Novak trade with a white bar. And they know about 30% of what it takes to take that trade. Or I'm going to take that Ron momentum trade. And they know about 12% of what actually goes into that trade. And they see other people in the room finding success. And then when they don't find that same success because they believe they're taking the same trades, they get frustrated. They get discouraged. So it's got to be your trade. It's got to be your plan. That's what the KISS plan is. But I'm going to read this real quick because I'm in a rambling mood, and tomorrow's a holiday and it's going to be a short day. The key to having everything is a foundation. We just built your foundation. We spent an hour teaching you to recognize advantages in the market. And then every day, every week, you're going to add just a little bit. You're going to grow. So for you new users, and apologies for you guys that want to be at the finish line before you run the race, I blanket you with very conservative rules. I give you a plan that optimizes your chances of success as you learn to read your indicators, as you become a chart reader. So for the new users, all termination conditions are bad. Tomorrow's Good Friday, Rob. The markets are closed. Sunday will be Easter. For all brand new users, no momentum is bad. If your areas aren't inside of favorable large triggers, guys, it's horrible if you're a brand new user. At least that's what I'm going to make you believe. Because the reality is that if you believe this as a new user, you're going to focus on the advantages, and it's going to keep you really in a good spot. But they're not always bad, and you'll learn how to go outside of them. Learn your rules like a scholar so that you can break them like an artist, right? But one of the biggest challenges that I see each and every day is when the new user tries to do what the experienced user does. When the new user with 3 weeks experience tries to trade like the user with a year experience, and guys, it's not fair to put those expectations on yourself. So keep it simple, focused on your entries, learn to read your charts. Once you can do that, once you can identify an entry, you're getting in at the right spot, you're feeling good about it, well, now you've got to manage it. You've got to do something with that great entry. Should we see if the market bumps? Here comes 10 a.m. news, guys. So I'm going to talk about your management. Your entries should be very systematic. Your entries should be 100% rules-based. Your entries should be based on the idea that advantages create the trade, not the desire for money. Your management, there it goes. Your management can be just as systematic, just as mechanical, because the reality is you're learning to read your indicators, and you're going to need your chart reading to manage. So if you are systematic in your entries, right? If it's 100% if then, you can allow your management to be the same thing. But if you don't understand how to get into the market where the market is most likely to continue, well, then your management plan automatically becomes skewed. And let me show you what I mean with this picture right here. Your very basic management plan, whoops, am I recording? Wow, that made a video somehow. It's doing it again. Accidentally hit time delay. Okay. This is where the rules say, right here, where the high probability trend trade originates, at the lowest point of resistance inside of favorable large triggers. You guys did all the study, and you said to yourself, but I do know, Mark, without question, that the market may continue from this box, from the highest point of resistance to the lowest point of resistance. So if you are identifying where the market is likely to continue, your initial stop has to go where it shouldn't. So let me show you how this affects it. If I jump in early, my stop still has to be up here. The only thing that I've done is I've increased my risk, and it doesn't guarantee a winner, guys. We're never guaranteed a winner. We're only guaranteed a pattern that has been proven to win more than it loses. If I wait and don't follow my rules and I jump in way down here, my stop, right? My stop is still there. All I've done is I've shortened the amount of space to get to that next key area. So if you really focus on the best entries, then you understand that if you're scared to lose more than $100, you risk being stopped out below an area of resistance inside of favorable large triggers. So all this to be said is you've got to be comfortable with your entries first in order to properly manage a trade. But great entries create very manageable trades. And if your first stop doesn't get hit and you get that reversal bar, you're going to go about 2 ticks above it. So you have just cut your risk in half. And now the market's starting to go with odds favorable momentum, right? The only reason we took this trade is because the large chart said to. So if you get the reversal bar, your risk is reduced. And it's either going to get stopped or it's not. For the brand new user, your first target's at $100. And guys, I'm going to tell you right now, I'm not a brand new user. I get paid at $100 almost every trade that I take. Almost every trade that I take, I get paid at $100 because I'm in this to make money. And for me, if I make $100, eventually when I create my plan, if I keep my risk on here, I'm still in a break-even scenario. Worst case scenario is I lose a trade on the second contract, but I'm still break-even on the whole thing. Something to think about. If it hits your first area, your first target, move your stop to break-even as a new user. Take the risk off. Have zero exposure, money in the bank, and this is your reminder that the only reason you took this trade is because a large chart said to. There's that momentum. So with no risk and money in the bank, it makes it easier to hold for the second target. That's the whole idea behind the KISS plan management, is to create confidence through the memory of success, to put you into the market where the market is most likely to continue. And then once you're there, give yourself the best chance to get money in the bank. Give yourself the absolute, positively best chance to build that confidence. Guys, and I'm telling you right now, the KISS plan, I've had people in their first 30 days with Nexgen get funded in those prop firms with the KISS plan. I've had people in their first 30 days with Nexgen win 70 to 80% of the time, even with the KISS plan, even incorporating medium probability trades. But I've also had people that have grown outside of the KISS plan, that have gotten too smart for the KISS plan, that started trading their opinions rather than their advantages. And guys, this is your grandma arms open, come back to the KISS plan opportunity. If you have found yourself losing more than you win, if you found yourself over trading, if you found yourself fighting rather than going with the flow of the market, it's okay to come back to this KISS plan. It's okay to go back to simulator. That's not a failure. That is an investment in your future. This KISS plan produces results. It always has. When people tell me that the trades don't happen, I say go back to the KISS plan, and suddenly they do. When people tell me that they can't make money, that they're losing all their trades, I say go back to the KISS plan, because what you'll find is that if you look for a little, you tend to find a lot. But if you look for a lot, you tend to find a little. So the KISS plan, guys, I'm going to drop it in the room. I'm going to start giving you all the gifts right now. The first one is the KISS plan. Use it or don't. It's okay. But at least you have rules to write on the chart so you can focus on advantages. The next one is I'm going to give you a checklist to enter the trade. Whoops, wrong one. I'm going to give you a checklist to enter the trade. And what this checklist does for you is it reminds you why you're entering in the first place, because you have advantages. And nobody's ever used this checklist truthfully and done worse than 70%. Let that resonate for a second. If your goal is to get paid, doesn't it make sense to give yourself the highest chance? The only reason anybody defers outside of this is because we get bored. I've also given you the same checklist with pictures of what it means to have the rules met, straight out of a user guide. And guys, all of this is designed to get you focused and become a chart reader as a brand new user. That's all it is. And then I'm going to give you one more. And this is going to be the one that none of you are going to do. And please prove me wrong and show me your spreadsheet. But this is the absolute positively most effective way to get great at recognizing advantages, guys. Take 25 pictures of strong triggers. It'll take you, I kid you not, it'll take you less than 10 minutes to go find 25 examples of strong triggers and put them into your spreadsheet. But what happens is that's 25 pictures of strong triggers. You're going to have a great understanding of what it looks like. And the same is true with weak and a clear path and terminations in a 50-50. And there's no doubt in my mind that if you put the effort in to fill this up, if you give me 50 pictures of strong triggers and 50 pictures of weak triggers, you're never going to confuse the two. And if you give me 50 pictures of a clear path and 50 pictures of a termination condition, you're never going to confuse the two. And if you give me 50 shorts and 50 longs, you're never going to confuse the look, guys. But the thing is people begin to study and then they get bored with it because studying isn't fun, and they begin to trade half-truths. And this is the final thing that I'm going to talk about. Well, Mark, my smalls were above the large. How come this long didn't work? Well, you traded into a termination condition. We heard this one yesterday. Someone that had been with me for a long time said, oh, you mean these divergence lines can be termination conditions? And I said, dag nabbit, every day for 3 years, I have identified divergence lines as a potential termination condition. But what happens is they never do the study to commit it to memory. They see it, they hear it, they go on. They don't continually repeat it. But Mark, I thought my path was clear. Price got above resistance. Well, the same lesson every morning is that the trigger lines define it, not price. But Mark, it didn't make it back to the area. How do I take this trade? Well, you don't, because the rules aren't met. But Mark, I had strong triggers. Why did this short fail? Well, Susie Lou, because you traded directly into a termination condition and it created an untradeable bounce. And you didn't follow your rules. So guys, it's okay to make mistakes, and it's okay to have all these situations where maybe you're not doing it right. But if you never present in the classroom, we're never going to be able to talk about how to do it better. And that's about as much begging as I'm going to do today to have you guys participate in your own education. So what I'm going to do is I'm going to take a break and I'm going to go walk around. And you know what? I might even have a popsicle because I love popsicles. True fact. You guys feel free to stretch. Stretch your legs, breathe through your eyelids. Jen, I'm still looking for the how-to manual on that. Get up from your computer and stop trying to fabricate trades. I'll be back in 5 minutes. We're going to start clicking on the charts that you guys posted. And when I come back, we're going to revolve around advantages. We'll watch the live market. Wolfman love popsicles, really? I'm a junkie, Ron. I do the sugar-free bomb pops, and I'm not proud of it, but I've been known to kill a box of them in a day. I've been known to kill a box of them in a couple hours. All right, guys, I'll be back in 5 minutes. If you have questions, post them in the room. If you have pictures, post them in the room. If you have been too nervous to ever post in the room, post in the room and say, hey, I can't wait to hear from you. I'll be back in 5, guys. Mic silence. Shops anymore. Been there, done that, done with it. Andy owns a security company. Period. got to get back to teaching my class. He said he's reached out to you about 10 times, period. I think you should call him. All right, guys, let's get back to it. Man, look at that. Termination for the win. Holy smokes. All right, this is the part of Classroom, guys, where I scroll up to the very top and I start looking at the pictures that you guys have posted. And we're going to talk about advantages, and we're going to talk about momentum, and we're going to talk about a clear path. And no matter what kind of trades you took, we're going to focus on the advantages. We're going to focus on your entries. We're going to focus on maybe when you might have been able to hold for bigger moves. And Roku got us going here. And Roku posted this chart yesterday, guys. So I want to give this to you folks that maybe can't be here for the whole class. I want to give this to you folks that maybe you can't be here for any of the class. Come back and post in the room, and that's for my YouTube listeners right now. Come back and post in the room. Come back and drop stuff in here, because I'll still analyze the charts. I'll still give you feedback. You just can watch it on YouTube later. So Roku came in, and let's see what you did, Roku. And Roku is a momentum trader. So he came out around 81.62. I love it, right at trouble. And I like this trade. So what happened is that was a 50-50 trade, and this 50-50 trade fails, guys, especially with divergences. 3 divergences in the same location tells Roku, hey, this was probably a bottom. They just overran it. The best momentum ever says it's likely to continue up. And Roku lets it clear a little bit of trouble on a smaller chart and says, you know what? I'm going to ride that wave of momentum right up to the next trouble spot. And Roku, it's a beautiful use of momentum. It's an absolutely solid use of momentum. And the market wasn't easy to trade yesterday, guys. There was so much indecision yesterday in the market. NASDAQ was consolidated. Crude oil was consolidated. So trading with that momentum created huge advantages for you. And then Jen comes in and just kind of reinforces the lesson. She's got those terminations, and this is a NASDAQ. Pink 1-to-1s are a termination. It reverses the market and produces strong triggers. And with strong triggers, Jen says, hey, you know what? I'm going to look for the trade. And I want you to see something here, Jen, because I love the momentum. I really do. I'm a huge fan of the momentum, because the momentum can break areas. Momentum can create huge advantages. But what I want you to see real quick, and I hope you guys can hear me. If you can't, well, I guess if you can't tell me. A lot of things happened here with this momentum trade. Is we're directly into support, right? And this is where you get in. And it's directly into support. And I want you to see there's a second hit, and then a pivot stop out, and then support holds again, and then those yellow 1-to-1s hold. But at the same time, it's holding to the downside in favor of the momentum. This is awesome, right? What a great hold. With this much momentum from a good top, Jen says, I'm convinced this market is going down. The second half of that, and I want to do this because, guys, there's different ways to trade, and some people will hold, and some people will enter and exit. If I'm in here, I like to respect trouble areas. I really do. I like to say, hey, you know what? This is problematic, and if divergence prints, maybe I'll take an exit. Because what happens is I have to sit through 1, 2, 3, 4, 5 retracements until everything agrees. Until it's no divergence, strong triggers, tight, large, tight synthetics. And the difference in price, I mean, geez, you're still in the 49s, right? So this little area right here and all that indecision for however long it lasts, take a shot, and if it doesn't work, it's okay. But eventually everything lines up and it's only a couple points lower. And that's where you have to figure out what kind of trader you are, right? I take a long, get paid, get out. I'll take a long again, get paid, get out. I'll make money both directions going that way because I'm trading advantages, right? I'm looking for the best of the best. I'm looking for the idea that I don't have to catch the whole move every time. I'm not a home run hitter the way I trade, but some people are, and Jen, you very much are. And I think it's interesting. Jen, are you with me in here? Can you hear me? I want to ask you a question about your management. Maybe. Can you guys hear me? Okay, just making sure. Down here at 459, without reaching the area, second divergence takes you out. And I think that's interesting because here at the areas, three divergences doesn't take you out. She went out for tea and crumpets. No, she's Australian. She's swinging with sharks, swimming with sharks. So Jen, we're talking about your trade, and we're talking about the idea that momentum is awesome. We're also talking about the idea that a pivot stop out at support can push a market back up. We're talking about the idea that you had to sit through 7 pullbacks because you traded directly into support with the momentum, right? And then eventually the area breaks, gives you a 50-50, no divergence, perfect entry. The difference is a lot less gray hairs and wrinkles, waiting for the best of the best. And I don't disagree with what you had here, but you had so many reasons to exit this trade, and you chose not to. And then down here, 2 divergences yanks you out, even though you didn't reach the area with the clear path, with strong triggers, all that. Just, that's it. Just, I love the trade, momentum for the win. But there's got to be a point. Because remember that the small chart gives information that the large chart can't. And 3 divergences in the same price range may terminate the trend. 3 divergences at Fibonacci support with none of the triggers through, that's a pretty big indication, especially when support just held twice. Like, you pulled one off here, but I think you got a little lucky with your hold. Because how often do we go back to the market and see 3 divergences push it up, right? How often do we go back to the market and see multiple divergences push it down? And how much of that fight do you want to be in? How much exposure do you want to stay in? Don't say it like that. It's not the errors. It's just something to think about, right? You let momentum lead the way. You let the large chart lead the way. But I'm telling you, especially because I know you're doing Apex, if this third divergence from Fibonacci support, pivot stop out, small triggers up, everything above it, reverses the market up to here, that's a pretty big equity push that just killed your trailing, right? So I'm not saying don't take the shot. It's okay to exit a trade and re-enter. It really is. It's okay to exit a trade. You get the 3 divergences off support. It pulls all the way up to those synthetics. You get a close on the correct side, and you're like, hell yeah, let's make money again. And then right at the pivot stop out, at support, none of the triggers through, you say, you know what? Let me get paid right here. And then it goes indecisive. And then everything agrees and it goes down easy. Jen, you had the opportunity to probably make several $100s in this consolidation if you wanted to be very, very fluid with your chart reads, and you'll get to that point. But have exit conditions. Remember that the small chart will show you change that you can't see on the large chart. The small chart will show you when the large chart is struggling. And 3 divergences, multiple divergences, no triggers through. It becomes a great management opportunity. I love the buy and hold, sell and hold, and I think that there's some merit for that. But I also think sometimes without a clear exit plan, you let hope take over a little bit. And strong triggers are pretty kick-ass, but strong triggers are only part of it. And there's a termination, and there's a reversal. I love your entry, Cav. You wait for it to clear trouble, and then out and out. Absolutely beautiful. And where was that trade? There it was. I took it as an HVA trade, Cav. And then when my small triggers, these 1-to-1s printed right as I was entering, and I said, shoot. So I wasn't willing to lose, and then I took your exact same entry on the correct side. I took it a little further than you did with all the momentum. But it's the same thing, and it was all predicated by that good top. It was all predicated by those strong triggers. And then, Jen, this is another good example. I took this picture because I wanted you to see this. This is a bad top. And this is a 50-50. And Jen, that's your favorite look ever, right? I love strong triggers. I paid for confirmation. And my plan says exit at the first sign of trouble and go break even. And I made $60 on this trade. But the cool thing is I never relied on hope of these strong triggers pushing. And I never relied on my desire for the market to go down. I had a very, very definite plan on how to handle this trade. And what it did is only $60, but hell, $60 5 times a day is $300, right? So it's okay to be active in your management, and that's for everybody. It's important to be active in your management. And I don't disagree with your mid-band at all here. No, you're doing great. You're stuck with me, Jen. We're going to be swapping Christmas cards. So let's talk about a chart read real quick. When I have a termination, beautiful termination, and this much momentum, Cav, mid-band doesn't scare me, especially with the large triggers that close to it. I like taking one off at the mid-band, right at the 1-to-1s. That's the beauty of an exit. But you have so much momentum everywhere, it's got a good shot of getting down a little bit further. Just maybe a little management thing there. Beautiful trade, though. Look at that. Triggers rolled down wide like a pair of scissors. I like that. That's some good annotation. That is not only identifying the look, but also the advantages, right? And then Cav jumped in, got run over. Dag nabbit. Joel, I don't have the chart. I don't have the chart for it. I don't have a picture of the conditions on the range chart. I'm sorry. If you want to look at the HVA rules, they're in the. But I'll tell you exactly what it looked like. Looked just like this. I had a termination, and then I had triggers roll, and then I had a pullback to an HVA line, and I went short. And that's exactly what it was. And if you look at that entry right there, where's Cav's picture? That's where my HVA line was, right there. Hopefully that's helpful. And then I like this one, though. This is the termination that creates the reversal, that gives odds favorable. Yeah, and maybe we can find it in a little bit. But it's the exact same look. The HVA line is there, Joel, but the rules have to be met on the large chart before I ever go to my range chart. And that's the part that most people omit, is letting the rules be met on the large chart. All right. Cav, I'm going to assume you were on a coffee run because that's your entry, right? And the triggers are starting to split, so maybe that's your first entry. A second lower divergence says we're probably going to take out this pivot, and it does. So there's your second entry. And then you entered Jen, it's a high volume area line. It's on the range charts. So if you look at a range chart, when I get a reversal bar, no, you're okay, and then a breakout bar, the high volume area of this bar, this is where every buyer on the planet said, go to hell if you try to go below this. And it creates a green line. So when the rules are met, these lines become very advantageous for looking to catch a move off at the bottom or off at the top. The pink lines do the same. So I'm not sure what time that short was. Class had already started. So this was my short off the top. You'll get there though. So Joel, do you see it? There was a termination condition. My fast triggers get below my small triggers. My small chart had given me odds favorable momentum. And I sold the pullback to this pink line. And it was perfect. Jen, you'll get there. And I think what you'll be able to do is use this chart, that range chart, to help you manage those larger moves, to help you have appropriate stops. And we can discuss that at some point. So Cav, the read is perfect. And that was just, man, I missed the party. And then when third divergence prints, could have been a smaller loss. You're welcome, Joel. Right? 3 divergences in the same price range, especially off of 1-to-1s. Say, let's jump ship. I love the large chart, though. The large chart is great. You just missed your entry and tried to make something happen. And I think that's what got you there, is the small chart said, you know what? Party over, Cab. Sorry, brother. And they'll do that sometimes. And that goes back to, you have to be active in your management, right? You have to be active in your management. Don't be passive. The patterns are awesome, but we still have to read the charts. And then JW, I'm trying to get yours up here. Here we go. Let's see what we have. So what kind of trades are we taking here, JW? Odds favorable momentum, not a clear path, pattern trade to mid-band. So I know what he means. When he has weak triggers and divergence prints, JW knows that the mid-band's likely to get hit. So when he began to break through here, I don't know where your first entry was. I can't see it. 82.48. Your entry was at 82.48 and your target 1 break even. And then 1 made 4 ticks. This has you in at 48 though. This has you in all the way down here. So did you let it clear here before you jumped in? It's weird that it doesn't show up over here. Okay. That's cool. That's still a major termination condition, and I like it. I think that, yeah, you probably got that about as best as you could. And I think you just got a little tight on your stops, right? Let it bump into something, and then you said, wait a minute, it's still going. And then you get to the mid-band. So a lot of work for just a little bit of money, but you made it. You did make it. It's a little jumpy. What about, call me crazy, when you get this divergence with weak triggers? So this is a plan, or this is a trade that Nexgen started teaching in 2004. So when you get this divergence with weak triggers, you know about it right here, right? You know about it right here, and you're thinking, man, let's go to the mid-band. But your small triggers are up here. Price loves to pull back to triggers, and this fib is probably going to cause a bounce. Look right over here. where fibs, triggers, everything comes together. I think what you'll find, JW, if you go back and study these patterns a little bit, this pullback to the small triggers is a pullback to the large triggers on the small chart, essentially. And then once you get a little confirmation right off that area, it just becomes a little easier. It gives you more room to trade that pattern to your target. Does that make sense? I think we might be able to get you in just a little more solid. And then the cool thing is if we're expecting this and we have large triggers up here, then we're patient and we're waiting for that reversal bar to get us in. We're waiting for that confirmation, because the reality is even though it's divergence, man, you have the granddaddy of all termination conditions right here. And this could very easily be the point where it's party over. Does that make sense? Great picture. And guys, this is JW trading a chart read. This isn't a high probability trend trade. This is awesome pattern study. This is amazing, looking at patterns over and over and deciding that there's an advantage. Termination condition pushes all the way up to the mid-band. Large triggers don't follow. And then it's weak triggers into the area. Weak triggers into the area reverses it. This is a strong bottom. And the market starts to come up. And Jen, this is where you love to go long, right about there. Does that look about right, Jen? No divergence, pull back. And then JW, check it out, man. Right at the large triggers. So from 85, it doesn't blink until 96. $200 worth of profit. Is there anything wrong with taking an exit and then re-entering on the pullback? And then look, it gives you a second divergence right from the 1-to-1s, and you know that it's going to get wonky. And then when it pushes back, Cav's saying, I'm going long here, but Cav, is it going to be here or here? Is it going to be the synthetics, the pivot stop out? Hell, I don't know. Why not wait for the close on the correct side of the triggers? And man, it still hasn't blinked since the close on the correct side of the triggers. Does that make sense? For you NASDAQ traders, the NASDAQ does stupid stuff, especially around fibs. The NASDAQ dances around fibs. The NASDAQ illustrates the fight so much. NASCrack, oh, I like that. And guys, I think one of the things that people forget, more than anything, every time you're trading the NASDAQ, and I hope I have some NASDAQ traders in here today. Guys, that's a 13.2. If this were crude oil or the S&P or gold or anything else, that would be a 5.1. And guys, this is a 34.5. And on any other market, that's only a 13.2. Hell, this chart is normally the large chart right here. So when you see these moves on the NASDAQ, and the NASDAQ moves fast, I want you to keep something in mind, and maybe this will help you guys out a little bit, is this is a bunch of consolidation, right? On a 13.2. That's what it looks like on the NASDAQ when the large chart probably says up, if you will. Do you guys want to do a comparison? You want me to build a 34.5 crude oil chart and just see what it looks like? Because I don't have any more pictures to look at. So why not take some lessons, right? Let's see what we have. And maybe for you guys that want to do bigger trades, right? Hold for longer moves. All right, so I'm building a 34.5 on crude oil. I'm going to put my 13.2 here and pretend it's a NASDAQ market. Whoops, I forgot to put a template in. Let's see, 34.5. I'll just use my NASDAQ template. So Michelle, It might go backwards. It may. Michelle, the easiest way to stay out of chop is to respect termination conditions. And Adriana gives us a great example of that right here. Strong top. And Adriana, I'm trying to see where you entered. 835, 835. So you went long. You went long when most stuff went down. You're saying, okay, maybe the termination condition will hold, right? And you get run over because of the momentum. I see it. It's okay. And then it looks like you go short directly into a termination condition. No, I see where you went long. You're hiding trades from me. That's okay. I see them anyway. And much to your chagrin, when everything is screaming down off a strong top, going long is a horrible idea. You get run over, right? And then saying, oh man, I got stopped out, I'm going to go short directly into support, you get stopped out again. You broke the most basic rules twice. You fought strong triggers and got run over, and then you traded into a termination condition and you got stopped out again. And then you went short, hoping that that same termination condition would break, hoping that the same termination condition that just took your money was just kidding, right? But the thing is, Adriana, is now your small triggers are strong up. Now they're above the large triggers. So you're caught in this limbo. You're caught in this, holy shit, one says down, one says support might hold, and you're guessing and hoping that the market does what you want it to do. Does that make sense? And I could be wrong, and please, guys, correct me if I put words in your mouth. Short didn't work into the termination, and you said, I'll get stopped out and go short again against the strong triggers. And you held that one, and you got out at the same trouble that ran you over, so you know it's problematic. And the triggers still don't break the area, and divergence prints, and you say, let me go short again into the termination condition. And then what was the result? It was able to make your first target. It did get just enough push to hit your first target. And I'm assuming the second target didn't get hit because it was weakening triggers and multiple divergences and the wrong side of stuff. So Adriana, your chart reading is amazing. It always is. And you tend to lean towards strong tops and momentum the same way Jen appears to. But there still has to be a little bit of respect for those termination conditions. There has to be a little bit of respect. And you just have to say to yourself, if it keeps holding, how many times am I willing to lose into it, right? How many times am I going to take this trade into trouble rather than just let trouble break? And only you can decide whether or not that's okay for you. But I'm telling you right now, I see this a lot. My brother and I fought for an entire week about this once. The difference of the potential to break versus broken is typically the difference between taking 1 or 2 easy trades and taking 4 or 5 difficult trades. So I hope that's helpful. And I love that you only showed me the one where the first target was hit, and you didn't talk about any of these. And that's okay. Okay, here's a 34.5, guys, for crude oil. So let's circle it right there. Notice that the whole day isn't a whole lot. So on the 13.2, that's the 5.1. Hold on. On the 13.2, and I don't have the correct triggers on my 13.2 to make it look like a trend trade. Where is that circle? 34.5. There it is. Check it out. It's a trend trade on the 13.2. So you guys trading the NASDAQ, I want you to tell me something. Oh, no worries. No worries. Thank you for that, Adriana. So guys, is anybody going long here? Looking at the 13.2 on crude oil? Help me out here. Does anybody see this look right here and say, man, I can't wait to go long? Strong triggers against me, large triggers against me. Nobody's going long here. Every one of you is looking for shorts. Every one of you was looking for shorts. And the reality is, this is your entry chart on the NASDAQ. Is this 13.2 is your entry chart? And then Michelle, what happens when it closes on the correct side from a bad top? It runs up. Because the overall trend and because the 34.5 said that we were going up. So I think that the point that I'm making is that this is the 13.2. Nobody's going long here. But for whatever reason, on the NASDAQ, you guys can't wait to do it. So if this were your 13.2 chart, nobody's going long. But because it has the illusion of a 5-1 chart, everybody can't wait. And I guess that's where I'm going with NASDAQ, is a little bit of patience, not fighting that small chart. Guys, the NASDAQ is a different animal. It's not the same time frames. It's not the same advantages and disadvantages. And I took this picture yesterday for you NASDAQ traders. Is my large chart said go long? Does everybody see it? My large chart said go long. No divergence, beautiful areas. Look at the small triggers. If I had gotten in at a mid-band, I'm getting absolutely decimated. So I put a stop order at the reversal bar marker. And now I've got my risk established. Now I'm on the correct side of momentum. Now I'm trading with everything over here. Because if this were a 13.2 chart, I'm not trading into those small triggers against me. And then I just go about my business, right? Then I collect my first profits. I get to break even the way my plan says. All that sort of stuff. So Jen, what I do is, and let's see if we can find an example, is let's say hypothetically to take a short on the NASDAQ here, and it's not rules met, I need a reversal bar. I can right click and go sell stop market 2. And the only way that I'll ever enter the market is if this becomes a reversal bar. And if it doesn't, well, then I'm never going to enter the market short. So the same is true when I know that I don't want to fight these triggers. The only way that I will ever enter this market is if I get a reversal bar to the upside, a close on the correct side of the small triggers. And I'm not saying that that's the only trade that there is, the only way to enter on the NASDAQ, because I will tell you that I've blown out so many accounts to learn that lesson for you guys. And I share that lesson in class all the time. And for whatever reason, people don't always do it. So Michelle, if you look at your trend trades, how many trend trades do you find yourself getting run over on? We're just going to turn this into a NASDAQ lesson, guys. If you thought the mid-band was going to hold, it kicked your ass. If you waited for a close on the correct side, you traded with the large chart beautifully. And I want you to see this. Small triggers is resistance. Small triggers is resistance. JW, this is your momentum entry on those other charts, on crude oil, on the ES. Divergence to get back to the mid-band, right? So These are great, great, great NASDAQ lessons, guys. And I'm telling you right now, I have absolutely destroyed accounts to learn these for you. And I try to share them with you. And what a lot of guys don't realize, a lot of you don't realize, is that this classroom has nothing to do with Nexgen protocol and stuff like that. All of it's Nexgen knowledge, but the reality is 90% of the lessons that come from me are from my mistakes, are from things that I've done as I learn to read the software, as I learn to take trades, as I break rules. So let's see what happens right here where I don't have the strongest triggers ever. And I'm just not sure. The large chart says that we're going up, right? The large chart says, hey, Mark, you should be trading with the trend. Things look good. I love it. But I don't have any areas. I just don't have any areas. And if all I do is wait for the close on the correct side of the smalls, I can trade with the trend, right? If all I do is wait for the close on the correct side of the smalls, it gets me up to that management point. And Rob, that's not even what it is. It's not do as I say, not as I do. It's, hey, Rob, guess what? I went out in the woods and I poked a bear with a stick and he mauled me. Rob, let me teach you how to not get mauled by bears. You don't have to do what I've done, is what it is you don't have to make the same mistakes I do, because, guys, I don't keep secrets from you. So if you're taking trend trades on the NASDAQ and you find yourself losing more than you win, did you have momentum? Did you have a clear path? Did you fight small triggers? Because there's these things. When you say not the entire pullback, what do you mean? I want to make sure that sometimes you guys say stuff and I get a little not sure on what exactly you mean. So let's do a hypothetical, Tony. If this is my window of opportunity, and let's just say that's it, this black box, and we have to use our imagination a little bit, this is where I'm looking to get long, because this is where my rules are met. Does that make sense so far? Is everybody with me? This is NASDAQ specific. I can't stress this enough. This is NASDAQ specific. So I want to get in at the mid band. But I notice that my small triggers are super strong against me. And I say to myself, with this much momentum on a 13-2 chart, it has the potential to push lower. And it does. And then I get a close inside of them. And Tony, this is where I know through a baker's dozen of ass kickings that resistance has that trigger has the potential to act as resistance. So what I say to myself is, if I agree with the risk, I take a close on the correct side. That's it. A close. Not just fluctuating above it, but literally a close. Why? Because look at how small triggers behave as resistance. Does that make sense? You're looking at it right there. All you guys that thought you'd go long at the pivot stop out to try and catch continuation, look what the small triggers did. And then the flip side is, with this termination, weak triggers, divergence, prints, some of you went short right there. 2 divergences, everything screaming, smalls on the wrong side. A lot of you guys went short, maybe to get to the mid band. But man, I'm telling you guys, this is, in my opinion, it takes 99% of the stress out of NASDAQ trading. And then when it crashes, it adds the stress right back in. Son of a gun. We were doing so great today, but I started writing on my charts too much. And that's my bad, guys. Haji, when I say a close on the right side, let me pull this up real quick and get that chart loading. And guys, I guess we're just going to go NASDAQ lessons for a while. Until somebody posts a chart, it's NASDAQ lessons. So let me show you my entry thoughts first while that loads back up. And this is it right here. And guys, I'm going to tell you right now, you don't have to incorporate anything that I ever teach you. You don't have to. But let me do something first. If you're looking for more trades on the NASDAQ and you haven't mastered this one, you're killing yourself, because the lessons from this one translate into the other lessons. So here's two different NASDAQ entries, and I don't remember who gave me this picture yesterday, but it's pretty awesome. When the rules are 100% met on the large chart, guys, and that is the key to everything. Jen, you lose your ass on a day like this? When areas hold? When termination conditions are present? When it seems to be bouncing? Last day of the quarter has nothing to do with it. Jen, if you look at your trades, so if we look at your first trade, right, where the market went absolutely spastic into the termination condition, but you held it anyway, right? And I'm not saying that's a bad thing, Jen. I'm not knocking you for it. But what I'm saying is that you completely disregarded rule number 2, and your brain said, don't bother managing it because rule number 1 is in place. And that's all it was. So what happens is the more comfortable you get with the software is you'll have the ability to manage a little more assertively. And this is one of the things that I absolutely just am awestruck with my brother. And this is why trying to trade like John Novak is gonna whip your butt 90 days to Sunday, is because my brother can take a long here and make $100 and exit it, and take another long here and make $100 and exit it, and then take the correct long and get paid, and then add on and get paid, and then add on and get paid, because he's got 27 years reading the indicators. He wrote the indicators. But the most important reason that he can do that is because he is extremely active in the management of his trades. He is 100% aware of what the potential challenges are in his trades. Everything that he does stems from advantages. I have this advantage, this advantage, this advantage. I have this against me. Therefore, if I reach this spot, I'll take profits. I'll get to break even. I'll do this. And guys, I'm not going to lie, the new user just doesn't have it in them. It's a lot of work to get to that point, but you can get to that point. So for you NASDAQ traders, rules met 100% on the large chart. If you can't say that, you're setting yourself up for failure on the NASDAQ. Plain and simple. If you can't say that your large chart rules are met, you're setting yourself up for failure on the NASDAQ. Because the NASDAQ respects termination conditions, and it reacts to termination conditions, and it relies on momentum because it is a bigger, faster, angrier market. So if I'm looking for the perfect trend trade and the mid-band is the spot, if the small triggers are less than a full bar away, they may act as resistance. And guys, there's that key word, may. You have to understand that your advantage is gone on the NASDAQ if the small triggers are less than a full bar away. And because of that, you have to be a little patient if you want to give yourself the best chance of success. And I want you to see what happens. There's your reversal bar. And this is where, and maybe this answers your question, Haji. You're thinking, okay, I got the reversal bar, let's go, right? There's my confirmation. But Haji, the NASDAQ isn't gold, and the NASDAQ isn't crude, and the NASDAQ isn't the S&P. We're fighting 13-2 small triggers on the wrong side of the large coming down against me, angry. And these triggers act as resistance very often. And if this were a large chart, JW just went short right there to get down to the midband. And it does. Those triggers act as resistance. The market continues down. But then if I wait for a close on the correct side, Haji, if I wait for that bar to come to completion and create a close, well, now I'm on the correct side of that fast-moving indicator. Now I'm on the correct side of the trade. Now I'm on the correct side of everything, and it increases my chance of success. Does that make sense? Guys, this is the patience entry on the NASDAQ. And if you incorporate this, if you begin to apply this, you will be absolutely floored at how many fewer trend trades you lose. So here's the second half of it. When I get to my mid-band inside of favorable large triggers, My small triggers are more than a full bar away. Do you guys remember the gap theory from the 13.2 chart? Do you remember when I told JW that the price bars love to return to the small triggers and that creates an opportunity for them? Guys, on the NASDAQ, on your entry chart, if price reaches the area and the small triggers are a full bar away, this is when I'll go at the area. So you give yourself two options, and let me drop this into the room for you. You give yourself two options. I'm either fighting the small triggers or I'm not. I'm either against momentum or I'm on the correct side of it. So Haji, absolutely a bar that prints. So if we go back to the NASDAQ, if to take a short trade, I need a close on the correct side of the small triggers, my only option is a sell stop limit on the reversal bar marker. And if it never happens, if I never get that close, if I never get that bar fully printing below it, and hopefully it'll just go up from here and you'll see what I mean. What it does is it keeps me out of a loser. It keeps me from taking that short. But here we go. Is it going to do it? Resistance, divergence, small triggers down, large triggers trying to roll. Now I'm in the trade. My risk is established, right? And I'm not fighting my momentum indicator at all. And guys, I'm not saying that this is the correct trade. But what I am saying is I at least gave myself a fighting chance by not getting in on the wrong side of those triggers. Does that make sense, everybody? And again, my large triggers are up and above the area. My small triggers are worthless here. I'm not saying that's a trade. So, Jen, this is where I went short. Price was up here. See my reversal bar marker right there? This is the price, Jen, where this bar becomes a reversal bar. That's all this marker is. So if this is the one that I got in on. Price was trading here, and I said, you know what? If it closes below, then I'll take the trade. So it had to create a reversal bar. Yeah, that's what this reversal bar marker is. And see the gold one up here? That's where this bar becomes a reversal bar going the other way. No. So I'm going to tell you a true story, Jen. You don't get to pick on you. You don't get to call yourself a dummy or stupid or anything like that, because the sad truth is you're going to begin to believe it. I'm the only person that can call you an idiot, and I'm not going to do it. Won't do it. Can't do it. Don't feel good about it. But guys, this is a pretty cool thing. Here's a glossary of common terms. Mark keeps saying one-to-ones. What the hell does he mean? What is that reversal bar marker, right? What is divergence? A runner? What does a runner mean? Well, a runner means that when this is screaming, Jen, that's your trade. That's a runner. So it's just a NASDAQ thing, guys. And I even put it in there, NASDAQery, right? So entry patience. I want to go short at the midband. Good morning, VM. But the small triggers are up strong. So what do? I wait for a close on the correct side, right? Pretty simple. Don't fight the smalls. Whoop, that's an error. Let's go to a different one. Yep, the smalls again. That's how I annotated this one. I thought I was going long at the midband, but the small trigger said give it a second. Darn smalls. I thought I was going long, but the smalls were against me, and I love this one. Can I show you guys something cool? If you went long at the midband, look at where the small triggers were, and look at what the price did. It bounced right off of them. So it's pretty cool, I think. The NASDAQ is a different time frame, and it's got to have a different set of rules. Whoops, I crashed again, son of a gun. I'm going to do a clean out real quick. I'll tell you what, guys, take 5 minutes. Go stretch your legs. Watch this. We'll put something clever up for you to stare at. I'll be back in about 5 minutes. When I come back, we're going to get into the last hour. Guys, I want the last hour to be whatever you want to talk about. I'm not just going to ramble everything in my head that I know about the NASDAQ. I'm not just going to regurgitate anything and everything that I know about termination conditions. I'm actually going to need you to ask me, hey, Mark, can we talk about this? Mark, here's a picture of something that I'm unsure on. And then we'll talk about whatever you want to, because it's fun for me to talk about stuff. I love the sound of my own voice. I'll be back in 5 minutes, and when I come back, we're going to finish strong. Guys, remember, this is our last live market day, because tomorrow is Good Friday. All right, here we go, guys. Last hour. Look at that. Hey, Michelle, is this where you have problems on the NASDAQ? Because I want to look at it big picture. And I think what happens, no, it's okay. Get those kids off to school. Super mom. I asked, is this where you have problems in the NASDAQ? Is this where you find yourself losing more than you win, or taking too many trades and over trading? Because this is a real common look on the NASDAQ, guys, and this becomes this huge red flag to me when I see it. So VM Tech, I've got you in 1 second. But what happens, guys, is I want you to see how simple it can be if you're willing to let it. Let me see right here. I'm going to try and get as much information as I can here to help. So this is consolidation. This is where people get chewed up, guys. Especially when you start becoming a chart reader. And I want to show you why. Because this is momentum. And everybody gets excited about momentum. Guys, I get excited about momentum. I'm not going to lie. But we get so excited about momentum that we don't apply the rules that tell us that this area hasn't broken. Right? So we're thinking, man, it's momentum. I'm going to take one of those kick-ass momentum trades right off the top, right? And it looks strong, doesn't it, Michelle? But because it's a 50-50, and guys, we've had this lesson a lot lately. Because it's a 50-50, this divergence kills it, right? This divergence lessens the likelihood of success on a 50-50. Is everybody comfortable with that idea? That's the first thing to keep you out of the long. The second thing to keep you out of the long is I can't fight these strong small triggers. So once again, I have a rule in place designed to keep me focused on advantages. If I took the close above, even though there was divergence on a 50-50, at least my risk is established. And then I hit support, right? And the triggers are down and they're flat and you're thinking, oh, I'm going short right here. There's one of those cool trades that I saw in the room, and you get lost and you lose again because you just traded into a termination condition. And then you're like, well, if it's not going down, I just lost that one, then I'm going to try this one again because that looks like momentum, even though there's no momentum here, right? And you lose that one and you're like, well, shit, I'm going short, but I can't. All my triggers are up. Damn it. And what happens, and guys, this is the biggest thing ever. Most people should say it's either rules met or rules not met. And the reality is most of you don't know your rules well enough to know whether or not they're met or not. And I hope that's a fair statement without sounding like I'm knocking anybody here. Most people in this room don't know their rules well enough to follow them. And they trade in terms of half-truths, which means that rules are kind of met, sort of met, almost met. How about this one, everybody? To most people, anyway. And this is what I find. So, Michelle, I can fix you. I can fix anybody. I really can. Until you're winning more than you're losing, until you're making money every day, just avoid 50-50s with divergence, which means, Michelle, that you can't take a momentum trade off of the top here if you have to wait to see if divergence is true. Does that make sense? Because we've talked about this with quite a few people in the last few days. You just haven't been here for it. If divergence kills my 50-50, I can't take the momentum off the top because I have to wait to see if divergence is true. And by the time it's true, the momentum trade's gone. It's not off of the fib anymore. And the other thing, if I promise myself to never trade into termination conditions, it eliminates a lot. If I only trade with momentum, it takes every one of these trades out. So If you can get yourself to the point, this is for everybody, where the only reason you enter a trade is because the rules are met, life gets easier. But here's the problem, is you have to know what your rules are, which means that it has to be simple, right? Gosh, we did this and I don't know that I still have it. So we're going to do it again. Let me pull up a Word document real quick. And we're going to create one together, guys. And I want you to see just just how much is going on in your head. So a high probability trend trade. Let's make this bigger for the people in the back and those of you that are old like me. So a high probability trend trade. This is 3 rules on 2 charts, right? So technically, can we agree that's 5 things to think about? That's not bad, except that you have to think about 5 things and put them together to create a trade. 2 charts, 3 rules each. And then if I add in the 50-50, well, that's still 2 charts, but that has 4 rules, I think, which is another 6 things to think about. So if I add that one in, now I'm up to 11 things to think about. And then if you say, man, but I really want that momentum trade that I see John Novak taking, right? And honestly, to do that one right, it takes 3 charts. And there is, let's see, 1, 2, 3, probably, I'll say 4 rules for that one. And now I'm up to 18 things to think about. And then what happens, guys, is I'm looking for this high probability trend trade, but I end up incorporating rules from the 50-50 and 1 rule from the momentum because I'm not so comfortable with this one that it's second nature. So until this one is really easy and the chart reads there, guys, don't keep compounding your trades. Don't keep adding your trades because you just end up with too much to think about, right? You end up with too many things to think about. And I think that that's one of the biggest problems that new users get into is they start to look for the trades, but they don't look for the rules to be met. And when they finally commit to looking for the rules to be met, they've given themselves so many rules, or they've stolen rules from other people, that they just can't keep it straight. Everybody's the same, VM, and I don't want anybody to feel left out here. Son of a brah. Because what happens, guys, is that it can be simple. I promise you it can be simple. Get really good at one thing. And then once you're good at the one thing, add to it, right? And I say this to people all the time. You're welcome. I say this to people all the time, and I went and did a little study the other day. One thing I'm going to start doing, and I don't know if this is a good idea or a bad idea, is I'm going to start a blog pretty soon where we're going to talk about some of the common things and put it out there for you guys. But there we go. How much money is traded daily? Guys, this is daily in a Forex market. Approximately $5 trillion worth of money is traded every day in a Forex market. $220 billion an hour. Let that sink in. $220 billion an hour, and your goal is 500 a contract a day? Do you really have to be in every move? Do you have to be the first one in at the top or the last one out at the bottom? Do you have to take risky trades? Do you have to fight momentum? VM, we don't even exist, these people. We're not even a blip on the radar. But this for me was absolutely staggering. When I'm trying to make my $300 to $400 a contract every day, the idea that $220 billion worth of money are being traded every hour, and all I have to do is be on the right side of it. All I have to do is go with momentum, go with the clear path, go with the advantages. It's a little humbling, really. And it makes me feel like maybe I don't have to work so hard to be good at this. So VM Tech, let's see what you did. And I want to address something before we start talking about your charts. Mark, I will be in session for a while. I did a bad trade, and I keep doing this and trying to avoid, but can't avoid it. Would appreciate if you can share your thoughts on how to avoid it. Overall trading is going good. So VM Tech, you can avoid it. It's not hard to avoid it. Not even a little bit. But here's the problem. Is what are your rules? So let's read your charts. Had a good gap between large and small triggers, thought it was good potential for a downtrend. You've got a lot of lines on your chart. All right, so let's do this, VM. Okay, I like what you did in regards to the momentum. You love momentum, right? So I'm just going to do this because, and please understand this is respectfully, the market doesn't give a shit what you thought. It doesn't. It doesn't at all. It doesn't care that you thought the market should still go down. Trust me, I've realized this. I've tried to impose my will. So let's keep it very basic. Odds favorable momentum, 100%. This is the best trigger look that you could ever hope for, VM. And everything that I do revolves around enjoying this look and trying to take advantage of it. But I want you to see something. And this is where I think that we're trading in half-truths. Until the small and large get through an area, it's not broken. Does that make sense? Are you comfortable with that idea? Until both sets of triggers get through the area is not broken. And I want you to see something. This area isn't broken. This area isn't broken. This area isn't broken. You have what appears to be 7 or 8 points of areas that aren't broken. Does that make sense? It's not just one, it's a metric ton. So this is potential to break, but hoping momentum breaks 4 areas. And that's okay, because sometimes momentum will. But I want you to see what happened over here on your smaller, faster chart. This divergence says a loss of momentum. This divergence is the first sign that momentum is slowing. You also had multiple divergences off of these areas that weren't broken yet. And in VM Tech, divergence means a loss of momentum. So down here, 4 times, your small chart said those areas have the potential to not break. Does that make sense? And maybe because you're not always in class, because I know that you've got stuff to do, maybe you've missed this super valuable lesson. And Jen, this is a great one for you too, because it focuses a lot on what you did this morning as well. One of you got lucky, the other did not. But what happens is if you begin to believe that 3 divergences in the same price range may terminate the trend, let me show you what happens here. Your short was at the bottom of the move. Nothing is broken. Nothing is broken. This divergence should have been your reason to exit, and you could have taken a small loss. Right, VM? You could have lost 50 bucks, 100 bucks. But I want you to see what you did. You went down $1,700 instead. $1,700 when your large chart said the areas weren't broken. $1,700 when the large chart said that 4 areas weren't broken. Almost $1,700 down when 4 times your small chart said, VM, you don't have to stay in this trade. You're not married to it. We're trying to tell you that things suck and we're going the other direction. But VM, I want you to see something. While you were hoping and praying and wishing, you had odds favorable momentum, and you had a pullback to support right inside of favorable large triggers, and it ran all the way to Fibonacci resistance. So not only were you so married to a failed trade that you missed the money going the other direction, and you were so married to a failed trade, but that was a good trade, and that had potential, and that had potential, all the way down. So what this tells me, and I'm going to find this because I made this in here. And guys, these are the lessons that we need as traders. Reading the indicators isn't difficult. It's really not. Reading the indicators isn't a tough thing. What becomes difficult is pulling the emotion out. Pulling the emotion out, keeping it mechanical. So this is something that I wrote up. I had someone reach out to me, and they're like, man, there's a lot of hope in my plan. So the things that you have to know before you ever sit down, before you ever pull the trigger, is you need to know what your rules for entry are, right? You have to know what it's going to take to get you into the market. And then more than that is you have to respect them. You have to hold them in the highest regard. It is hard, VM. But the problem right now is you're so focused on the finish line that you're not focused on what it takes to get there. There's too much hope in your plan to be a successful plan, in my opinion. And my opinion means nothing. So let's simplify. If I know what it takes to get in, and for you it's momentum, right? You love momentum. And you love it when the small triggers break through, and that's kind of your bread and butter. And that's cool, right? I'm never going to knock you. You even let it get it below the blue fib. That's okay. Take that entry, right? So you know what it takes to get in. So for you, what's it take? It takes strong triggers. And I think you like the smalls through. Price below. Go, 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 right? So that's your entry. It's pretty simple. It's consistent. But here's the hard part, or the most ignored part. What are my management rules for after I enter? So I have to know what kind of trade it is. VM Tech, can we agree that your trade is a momentum style trade? 100%, right? It's momentum based. It relies on momentum. Okay, so here's the question. Why on earth don't you exit when the basis, the reason, the core, the crux, whatever you want to call it, of your trade goes away? If momentum gets you in, why the hell are you still in it when there's no longer momentum? And even more so, VM, why would you feel like it's okay to have momentum against it and still stay in? If this is enough to create a win, isn't this enough to create a catastrophic loss? So what you run into is you have to come up with some sort of plan that says, I'll take this trade, right? VM, you're like, man, I will take this trade. Hell yes, I'll take this trade with momentum. But what I'm going to do is if my small chart tells me momentum is going away, if I get a couple divergences, if I get something going wrong with this small chart, even though the small are below the large, I'm going to exit this trade and I'm going to wait for the next best opportunity, because the reality is, VM, is you're good enough to do that. Jen, you're good enough to do that. Your chart reads are good enough to do that. And then here's the second thing. What's your daily goal, right? What are you trying to make every day? I see a lot of people tell me, I'm a brand new trader and I want to make $1,000 a day. Guys, you're brand new. Why on earth do you think you should make 20 grand a month as a brand new trader? And you will get there. But what if you took the pressure off? And VM, what if you said, I need to make $500 a day? That's still, that's 10 grand a month. That's not a bad month. That's $120,000 a year. How much pressure does it take off of you to only have to make $500. How easy would it be for you to make $500 and then shut down? And VM Tech, $500 to $1,000. That's like saying, I'm going to go to the buffet and I'm either going to eat a chicken ring or I'm going to eat 173 chicken wings. 500 to 1,000, that's a big discrepancy, isn't it? And I don't think that that's the challenge, is your goal. I think this is everybody's challenge. How much are you willing to lose in a day, VM? And we're about to have an aha moment together. Well, you don't hate it that much because you're good at finding it. How much are you willing to lose a day? Before you say no more, what's your pain threshold? $500. All right. So you're telling me that you're only willing to lose $500, but you're willing to let a trade go against you $1,700 with the hopes that things turn around? Does that feel logical at all? Not so much. And I'm not trying to beat you up. Not at all. But wouldn't it be cool, VM, if you said, this is what I'm going to do? And let's go back to Microsoft Word here. And let me close that. I don't want to save it because I don't want to do that. So I'm just going to open one real quick. What if we said, just for grins, I'll take a momentum trade per my rules. And I'm not going to go through all of your rules and stuff like that. Is that fair? So there's your entry. I'll take it per my rules. All those things that you look for to get into a trade. I will exit if $500 profit, divergence on small chart, because this represents a loss of momentum, area reached. So all I want you to do, VM Tech, is I don't want you to change anything because I love your momentum trades and I think that you find more success than you don't. But you have to be willing to lose. You have to be willing to lose. And right now you're not. And you're so lost in the idea that losses are bad that you really set yourself up for catastrophic failure. Just catastrophic failure. Because what if this market goes up and just keeps going up and keeps going up and keeps going up and keeps going up? I'm sure none of you are old enough to remember this, but there was a time in the 90s where I want you guys to pretend like this down move represents $12 million worth of money. I want you guys to pretend that this down move represents $12 million of money. And there was a client that went long right here, right into a termination condition, without strong triggers, without a clear path. And they were so sure of themselves that even though the market had turned, they went long again. And even though momentum was gaining, they went long again. And right about here at the mid band, well, there's no way the market can keep going down. So they went long again at support. And then they did it again at the divergence low. And then they did it again at Fibonacci support. And they did it again at Fibonacci support. And they did it one more time at Fibonacci support. And it was right here that their broker called them and said, you need to give me more money. You're down 12 million in your account. Guys, this is a true story. I remember when this happened. And this is one of the problems with not having a management plan in place. This is one of the problems with leaving your emotions and your opinions to management. And Michelle, you're right. Stopping in the red is hard, isn't it? But I'm going to tell you right now, if you hit your stop loss and you go to sim, you're going to win for the rest of the day. Right? If you hit your stop loss and you go to sim, you will win for the rest of the day because you don't care, because it's just sim. And VM, you're great. But you're doing Apex, right? So your trade, that's almost your entire stop loss right there. And what you're doing is you're setting yourself up. Hey Tony, take care, man. Have a great Easter. We are too good at what we do when we learn the lessons to put that sort of exposure on the table. And what's great is, and especially with Apex, the idea is to get paid, and when it's not going right, we get out and we wait for the opportunity to get paid. But inside your one move, there was your failed short, and I can get on board with taking it and losing it. There was a long trade. There was an HVA trade. There was a high probability trend trade. There was a short. There was a short. And then down here, you exited for virtually no profit. But you missed $1,000 worth of profit in there, taking the easy trades. And I love that you shared. And I know that sometimes it's hard to hear that. It's hard to hear that I didn't do it right, that it's not the right setup, that I held for too long. But if you hear it a couple times, my brother used to tell me, Mark, eventually you'll get so tired of breaking your rules and losing that you'll stop breaking your rules. And what's funny is the first time he said that to me, I didn't even have rules. The first time I lost $5,000 in a few hours, I didn't have rules. I didn't have anything to check myself against. Guys, you have the most solid freaking plan in the world. You have the best indicators in the world. You have the absolute, I think, call me a little horn tooter here, but I think you've got the best education in the world. I think you have the opportunity to get feedback on anything and everything that you see every day to get better. So, I mean, you've got the world's greatest hammer. You've got the golden goose, but you keep making fried chicken. Eventually, you've got to commit to simplicity. And then from simplicity, you will grow, I promise. And the biggest thing is most of us don't want to wallow in simplicity long enough to get to the growth, is what I have found historically. Past doesn't guarantee future and all those other things that we have to say. So, tells you right where they should hold, but you have to respect them, right, VM? Just because you know where they are, you still have to respect them. You still have to say, man, the rules say that it may not hold. Ron says that when divergence prints, why not capitalize on the pullback? Big gap back to the smalls. That one's a little risky, Ron, but I like what you did there. Divergence, quick profits. Guys, this is not a trend trade. This fights direction. This fights momentum. Doesn't come from an area. It relies on that loss of momentum. The same momentum that you guys fight to stay in. Ron says, let me just ride that loss of momentum back to an area. I love it. And I got to tell you, Ron, I implement your idea when I'm taking those white bar trades that we were discussing. Is that if I get in and a second divergence prints, I've got a pretty good idea. But the large chart's got a rule for the basic mortal, guys. Large chart's got a rule for the basic mortal. All right, Rob, let's do it. Let me pull up my spreadsheet real quick. So we'll do this. We'll turn it into a lesson as well. Let me pull up that large chart because I do love me a large chart. And I'm going to take a picture, guys. It should be Monday. It's closed tomorrow, Ron. And I'm going to do this right here. I'm going to take one arrow. and I'm going to say strong triggers. And I'm going to say smalls above large. And I'm going to say advantage of momentum. This is rule number 1. Does anybody disagree with that? Seems pretty logical, right? So I'm going to click share link, and it's going to give me a link to screencast. I'm going to show you guys. So there's my link right there. And if you click on that link, guys, it opens a picture, the same picture that we just took. So Rob, I'm going to go to strong triggers in my worksheet here, in my spreadsheet. And I'm just going to paste, bunk. And there it is, app.screencast.com, letters, numbers, jargon. You could do it like this, and I'm going to tell you right now, 3 years ago when I finally embraced the idea of using the spreadsheet, I had about 400 links that weren't hyperlinks, and they worked just fine. You can hit Control, click on them, and open the link. But what you also can do is you can go to Insert, and you can go to the link button, and this is your hyperlink button. VM, take care, have a happy Easter. And then you paste that same screencast address into the address bar. And change text to display. Let's call it strong. Next Wednesday is the OPEC day all day. I do remember the chaos. And then Rob, there it is right in there. Yeah, Ron, that was crazy, right? So guys, we check news every day. And next Wednesday is OPEC meetings all day. Is it high impact this time? OPEC meetings, so it is medium impact all day. Guys, last time there was high impact, OPEC meetings all day, and it was rough. A lot of people lost a lot of money, and Ron, it catered to your plan. Great. So we'll remind you guys on Wednesday. So Rob, that's it. And Rob, if all you can do right now is drop these in there, that's okay, because you can still come back. You do play backwards. That's a good way to put it. You can still come back and check those links. Did that make sense? Okay means I have no freaking idea what you did, Mark, but I don't want to ask twice in most cases. Do you want to go through it one more time? No, that's okay. That's right. I forgot. You are. No worries. So Rob, you're the only one that okay. I won't say it means I don't have any idea. Michelle, there's your consolidated market, right? So what do you think, guys? Could we say something clever like, in order to take a trade, I need to break the top range and the bottom range and wait for a clear path? And it didn't cost you a penny, Jen. Didn't cost you a penny to not be in a nonsense market. And you know what's kind of cool is eventually you'll get to a point to where you'll say, man, this is an edge and there's a couple divergences and you know what, they're range bound. Maybe I'll just go long and see if they go up to the next edge. And I'm not saying fight triggers. And this would be where Ron would have had to get in earlier, I think. And he says that usually goes to the reversal bar marker. And I'm not saying that it's an actual long trade, but I'm saying if the market hasn't made it off of an edge in 3 hours, some people will just trade the edge. Of course, it's always easier when you're on the right side of things. But I've seen people do this too. And of course, I'm fighting triggers, which is a recipe for success. So we'll just close it out. But you can do these things where your next step becomes where when you get this pivot stop out up here, even though it's range bound, maybe you wait for everything to agree and you look to get to the next area, right? Maybe if these triggers roll and it starts going up, I don't try to hit a home run. I just try to take it to the next area. And Ron, your counter trend should work but doesn't, or shouldn't work trade didn't work, right? Just didn't make it. Not this time. So, guys, that's it for me. Yeah, it's holidays, guys. I will be here tomorrow morning, and if there's people here, I'll do a 101. There won't be any live charts. There won't be any live markets. I don't even know that I'll open it up. We'll go through the rules tomorrow. If you have questions, tomorrow will be a great time. Bring me pictures. Bring me pictures. I'll be here at 9 a.m. And then how soon we quit will be up to my discretion. So if there's nothing going on and it's just 5 of us in here, it's not going to be a long day. For those of you that don't make it in tomorrow, do me a favor. Have an awesome Easter, regardless of how you feel about it. Have an awesome Easter. And I will see you guys either tomorrow or we'll catch up with you on Monday.